Howdy, Jacob here. Today we're looking at Immersion Corporation. We're doing a one-off analysis. Okay, it's in the technology, hardware, storage, and peripherals industry. I believe that's actually the same as HPQ, technology, hardware, storage, and peripherals. Okay. So $214 million market cap on 63 million enterprise value. So they have very little debt here. Looks like they create, design, develop, and license haptic technologies that allow people to use their sense of touch to engage with and experience various digital products around the world. Okay. Company was incorporated in 1993. They're used for communications, wearables, consumer electronics, gaming, and VR, and automotive. Okay, interesting. So the company itself, it's really all over the place. This is going to be kind of tough. So recently, obviously, you're looking at some fantastic results here. Five PE, 20% return on invested capital. Um, I mean, no debt, I presume, because okay, we have $150 million in very liquid assets, no short-term debt, no long-term debt. So from a balance sheet perspective, you're looking at a very safe company. Now that you know it's safe, though, from a balance sheet perspective, it could be not safe due to not positive earnings and free cash flow. And we are seeing positive earnings of the last 5 years outside of 2019. Very positive earnings. In fact, this is crazy. 31. So their net interest expense was actually positive, and they gained money on interest expense, and then their income tax was positive. That's peculiar. So just a very good year. And then here you did margins greater than 100%. 38 net income on 33 million revenue. That's interesting. And then here 40 million free cash flow on 38 million revenue. I don't fully comprehend that. I mean, obviously, see gross margin is 100%. We see that at the start. Yeah, 99%, 100%. So that's great for them. And then their operating profits dig in a bit, but then it looks like their income tax and net interest income is crazy positive, which is just very peculiar. Um, okay, I mean, on a 5 year average basis, it's really all over the place. You have as high as 70 million, as low as negative 34 million, probably averaging out to about 30 million, let's say, 20 million, 25 million. And their use of cash flow is a bit of reinvestment back in themselves, okay? And the current high rate of return that they're getting, return on invested capital, could be a great idea. And then looks like outside of 2021, heavy issuance of shares to do that reinvestment. They've been buying back quite a bit, and then now they've been paying a dividend that is aggregated out at 6 million, which on a 5 year average basis of about at least 20 to 30 million, they can absolutely afford that with a payout that's 30%. That's very minimal. Still leaving a lot of room to reinvest and buy back shares that are hopefully stupid cheap. All right, so let's start making some assumptions here. On the revenue side, I'm not sure. We'll see. I don't know. It's kind of tough. Looking at history, it's actually down from 10 years ago. Was there any devastations? I don't remember looking at that. Okay, they don't have probably don't have acquisitions, but yeah, pretty. I think I'm pretty much in line with increasing with inflation, and then saying at the end of 7 years, maybe a similar growth rate, and then hopefully they find some new opportunities to invest in, which you've seen recently. Their margins are as high as over 100%, which is pretty crazy. But I'll just take an average here and say maybe they're going to chill within the 30 to 35% range, and then they'll probably buy back those 2% of shares. Rough math is about $4 million. I mean, that's nothing. Let's say 3% buyback, maybe $6 to $7 million, $6 million for a payout. They can afford that, and I'm assuming increases. So let's increase that relatively in line with their revenue. And then the cash remaining will be for reinvesting in for growth so that they can reach this 3%. But to me, right now, it still gets us to a price point that needs to fall 54%. And really, the reason is because right now it's very inflated in my perspective on the margin side. And I'm just not entirely confident that they can keep these type of margins. And so I feel like it's going to dwindle down closer to the mean. And when it does that, if you look from that perspective, it doesn't look as screaming of a deal. So hopefully this video was helpful and is reviewed in conjunction with your own analysis and kind of helps out kind of my comprehension of viewing companies and such. So hopefully you have a great rest of your day. Thank you.